Yo, what is up everybody? It is Falar here and I hope you're having a wonderful weekend after the hectic week in the finance space. Today I want to talk about the Chinese tech sell-off and how billions of dollars in market capitalization was lost for companies such as Alibaba, Tencent, Didi, and many more. Forbes actually recently announced an article that over $150 billion in market capitalization was lost for the top 10 Chinese tech companies this last week. And the losses are even more staggering when you zoom out to a longer time frame. So let's look at some numbers. So Alibaba specifically went from trading at its 52-week high of $319 per share this last October 2020, to actually hitting its 52-week low this last Tuesday at $180 per share, which is actually a 43% decline, which is crazy and unfathomable. Tencent has suffered a similar fate, going from its 52-week high of $99 per share in February to its 52-week low this last Tuesday too, $56 per share, which is roughly a 43% decline also. Much of the loss in value is attributed to the changing investor sentiment and the rising concern over the increased regulatory pressures the Chinese Communist Party, or CCP for short, has enacted on its domestic companies. Tencent, for example, which is a major conglomerate made of different branches such as social networking and online gaming, has actually been forced to end its exclusive music licensing deals within the next 30 days on the Tencent music platform. Tencent education has also been decimated as the CCP has prevented companies from making a profit on services related to educating individuals with courses and subjects taught in school settings in China. Didi has not fared much better. Despite heavy opposition from the Cybersecurity Administration of China, the ride-sharing company, think of it as synonymous to Uber, went public back on June 30th. This led the CCP to actually prevent users in China from downloading the app entirely, and led to a full-force investigation for multiple departments of the Chinese government, including the Ministry of Public Security and the Ministry of State Security. China is debating how to further fine Didi for its actions and is thinking about banning certain Didi services and also imposing a fine greater than 2.8 billion, which is what Alibaba suffered for its antitrust investigation. Regardless of past penalties and looming regulations, the financials of many Chinese companies remain sound. Morningstar, for example, estimates that the fair value of Alibaba stock is around $313 per share, which is in the 4 to 5 star investment range, meaning that it has a high probability of appreciating in value over a multi-year time frame from its current price, which is roughly $196 per share. Along with a fantastic revenue growth of 40% this last year, Alibaba trades at around a PE of 23.4, which is significantly less than the entire internet/commerce sector in general. Tencent is in a similar position, with Morningstar estimating that its fair value is at around $103 per share, which is very far from what it's currently trading at, which is $63 per share, meaning that it's roughly in the range of being a 4 to 5 star investment. It is also trading at a PE ratio similar to that of Alibaba at 21.1 and has a large runway for future growth. This just is intended to serve as a brief overview of the companies and why they might be undervalued in today's market. Even with this knowledge, I would be hesitant, however, to allocate a large position in one's portfolio towards Chinese companies. It is only speculation at this point, but we don't know how far China will go in terms of antitrust regulations and how much short-term pain they are willing to inflict on its companies for long-term prosperity. Any investment in Chinese stocks at this point is a high-risk bet in a rigged economy where private companies do not have a say and are in the stranglehold of the objectives of the government. I hope you enjoyed the video, and until the next one.